At 1:45 on Monday morning, September 15th, 2008, one of the most powerful investment banks in the world filed for bankruptcy. Lehman Brothers controlled more than $600 billion in assets. It employed approximately 25,000 people. It had survived wars, depressions, recessions, and financial panics for more than 150 years. But before most Americans finished their first cup of coffee, Lehman Brothers was gone. Its collapse did not remain on Wall Street. It spread through banks, retirement accounts, businesses, and governments across the world. This is how one financial empire nearly pulled the global economy into the abyss. And it began with one dangerous belief: housing prices could never fall everywhere at once. Lehman Brothers started as a small dry goods business in Alabama during the 1800s. Over time, it transformed itself from a commodities operation into one of Wall Street's most influential investment banks. By the early 2000s, Lehman was deeply involved in America's booming housing market. Banks were issuing mortgages to millions of homebuyers. Wall Street bundled those mortgages together and sold them as mortgage-backed securities. As long as homeowners continued making payments and housing prices continued rising, the machine generated enormous profits. Lehman wanted a larger piece of it. The firm purchased mortgage lenders, expanded its real estate business, and accumulated billions of dollars in property and mortgage-related investments. The money was spectacular, but Lehman had built its empire on leverage. Leverage means using borrowed money to control assets much larger than the amount of money you actually own. Near the crisis, Lehman controlled roughly $30 in assets for every single dollar of equity supporting them. That works beautifully while asset prices rise. But if those assets lose only a few percentage points of their value, the firm's entire financial foundation can disappear. Then the housing market turned. Mortgage defaults increased. Home prices began falling. Securities that Wall Street had treated as safe became difficult to sell. Lehman insisted it could survive. Its chief executive, Richard Fuld, had led the firm for years and developed a reputation as an aggressive survivor. But determination could not change what was hiding inside the balance sheet. Lehman depended heavily on short-term borrowing. Every day, it needed other financial institutions to continue lending it money. That meant Lehman did not merely need assets, it needed trust, and trust was disappearing. The company also used transactions known as Repo 105. Near financial reporting dates, Lehman temporarily moved tens of billions of dollars in assets away from its balance sheet, using the cash to reduce the debt it appeared to be carrying. After the reporting period ended, the assets and debt returned. Imagine hiding several loaded suitcases before an inspector enters the room and bringing them back after the inspector leaves. Investors were shown a cleaner financial picture than the reality underneath. By 2008, Wall Street was already in crisis. In March, Bear Stearns began collapsing. The Federal Reserve supported a deal allowing J.P. Morgan Chase to purchase the firm. That rescue sent an unintended message. The government would not allow a major Wall Street institution to fail. Lehman's leadership appeared to believe someone would eventually rescue them too. But Lehman was running out of time. Its share price collapsed. Clients withdrew money. Trading partners demanded more collateral. During the weekend of September 13th, government officials and Wall Street leaders gathered at the Federal Reserve Bank of New York. They searched desperately for a buyer. Bank of America chose Merrill Lynch instead. Barclays showed interest, but the transaction could not be completed without guarantees unavailable before markets reopened. The government refused to provide the financial support used during the Bear Stearns rescue. There would be no buyer. There would be no rescue. Lehman Brothers filed for bankruptcy. Workers arrived carrying boxes from their offices. The message was unmistakable. If Lehman could disappear, nobody knew who might be next. The Dow Jones Industrial Average fell more than 500 points that day. A major money market fund held Lehman debt. When that debt collapsed, the fund fell below its promised $1 share value, an event known as breaking the buck. Investors began pulling money from similar funds. Those funds normally helped finance the daily operations of American businesses. When that market froze, even financially healthy companies faced difficulty borrowing money for payroll, supplies, and operations. The panic had escaped Wall Street entirely. Lehman Brothers did not collapse simply because it owned bad investments. It collapsed because leverage magnified those losses, and lost trust removed its ability to survive them. Enormous assets do not guarantee safety. Profit does not guarantee liquidity. A company can appear powerful until the people lending it money decide they no longer believe. That is the hidden weakness behind every financial empire built on borrowed money. The structure appears unstoppable while confidence is rising. But when trust leaves, size becomes weight, and the empire crushes itself. Subscribe to Outlaw Wisdom for more financial history and the lessons traditional education left behind. They never taught you this. We ride until they do.